So what's better, Roth 401k or traditional 401k? I want to show you this simple comparison chart so that you have a solid understanding of the differences between a traditional 401k and a Roth 401k, just so that we're on the same page. The personal contribution limit is $22,500 for traditional or Roth 401k. Now you can do a combination of both traditional and Roth, and as long as you don't exceed 22,500 if you're under the age of 50. And if you're over the age of 50, you get an extra $7,500 in catch-up contribution, or a total of $30,000 in the year 2023. Your paychecks and employer matches can go to either traditional or Roth 401k, depending on what you elect to contribute to. The new law states that you can actually put your employer matches in the Roth portion of the 401k as long as you pay taxes upfront. And a traditional 401k is used to make contributions with your pre-tax dollars, right? So it's the dollars before federal and state income taxes are taken out. A Roth 401k is used to make contributions with your after-tax dollars. So it's the dollars after the taxes are taken out. And if you retire at the age of 55, you can actually withdraw from your traditional 401k penalty free, but you will owe taxes on the distributions. This is also called the rule of 55. If you work until age 55, it doesn't matter if you got fired, laid off, or quit your job. As long as you work until age 55, you can withdraw from your 401k penalty free. And if you wait until you're 59 and a half to take distributions from your traditional 401k, the same rules still apply with no penalties, but you still owe federal and state income taxes, right? But again, your distributions will still be taxed, again, because you made pre-tax contributions. Basically, you're paying taxes on the back end. And every traditional 401k comes with a what's called a required minimum distribution, okay, or the RMD. You can't shelter your pre-tax money in your traditional 401k forever because the U.S. government wants you to pay your fair share in taxes. You'll need to Google the IRS RMD web table to find out the maximum age you can hold your traditional 401k before you have to start making distributions. And when it comes to the Roth 401k distributions, the rules are a lot different from the traditional 401k because you already pay taxes on your contributions. So you'll need to segregate your personal contributions and the earnings and interest that accrued inside your Roth 401k. If you retire at the age of 55, you're not going to be penalized on the earnings, but you will be taxed on the earnings. If you wait until you turn 59 and a half, then you don't get taxed or penalized on the distributions, which includes your earnings, interest, and personal contributions. There are also no required minimum distributions for the 401k because you already pay taxes on the contributions. So you could hold on to your Roth 401k for the rest of your life if you want to. So the bottom line is that if you withdraw money from a traditional 401k before you turn 55, you're going to owe a 10% penalty and ordinary income tax on the entire distribution. If you withdraw money from a Roth 401k before you turn 55, you're going to owe a 10% penalty and ordinary income tax only on the earnings and interest that accrued inside your Roth 401k, but not on the contributions you made because you already paid taxes on them. Makes sense so far, right? However, the rule of 55 for a Roth 401k is a lot different from a traditional 401k because you can't just choose to take out the Roth contribution inside your 401k early. There's a thing called a pro rata rule that will apply to your early withdrawal. So let me give you an example here. Let's say you have $500,000 total investing in your Roth 401k account. And out of that $500,000, you contributed $200,000 in Roth or after-tax dollars. And $300,000 of that is in interest and earnings. So you have 40% in Roth contribution and 60% in earnings and interest, right? If you need to find out how much earnings you accrued, you just find your total cost basis and subtract it from the total amount. You may just have $100,000 right now in your 401k with a cost basis of $70,000, and earnings and interest of $30,000. So that would be a 70-30 in total 401k portfolio, right? But anyway, let's say you want to retire at the age of 55 under the rule of 55. Since this example shows 40% Roth and 60% earnings, if you withdraw $10,000 early, $4,000 of that would be tax free because that's your Roth contributions. But $6,000 of that would be taxed by the IRS under the ordinary income tax. If your marginal tax rate is at 24%, you will owe $1,440 on your income tax out of that $6,000 in earnings and interest. I am not planning to withdraw early from my Roth 401k because the penalty and taxes, even with the pro rata rule, would be too much, right? The other thing I want you to keep in mind is the required minimum distributions, or the RMD. The Secure Act 2.0 President Biden signed in 2022 removed the RMD for Roth 401k. For the traditional 401k, Congress increased the mandatory withdrawal age from 72 to 75 starting in 2033. And the RMD is now 73, which starting in 2023. And then it's going up to 75 on January 1st, 2033. If you're already 72 years old in 2022, you will have to start taking minimum distributions. So what comes down to how to choose between Roth versus traditional is when you want the IRS to take its cut from your retirement. Now, when does it make sense to contribute to your Roth account or your traditional account? If I'm in my 20s, 30s, 40s, or just decades away from my normal retirement age at 59 and a half, then I would consider a Roth contribution over a traditional 401k. I also believe the marginal tax rates will go up in the future. And our tax rates right now are really low thanks to Tax Cuts and Jobs Act in 2017. But that is set to be expired by the end of 2025. With the declining birth rate and decreasing government revenue from American workers, I personally don't think that the government would have any choice but to change the tax system in the future. Could I be wrong in the future? Absolutely. But do I want to bet my retirement on that? Absolutely not, right? And I would also consider what my retirement income is going to be. Ideally, I would like to stay under 22% in the marginal tax rate. A 12% marginal tax rate would be even better. So if you're about to collect your Social Security retirement pension, and you have to keep in mind that the pension you receive is taxable by the federal and sometimes the state governments. If you're a military retiree, federal government retiree, state government retiree, or you receive some type of pension from the private sector, the pension income you receive is taxable by the IRS. You should calculate how much you'll owe in taxes the day you start receiving your Social Security pension, and how that's going to affect the cost of your Medicare B premiums in retirement. Having a Roth account would reduce your overall taxable income during retirement, but having a traditional account could increase your taxable income because the distributions from the traditional account are taxable as well. The other factor is that if you're in your 20s, like I said earlier, your income is typically lower than those in their 30s, 40s, or 50s. And I would take advantage of the low tax bracket and pay the taxes now, so I don't have to pay later on in the future. So if my marginal tax rate as a single person is at 12%, making $45,000 a year, then the dollars I contribute to Roth would grow exponentially. Eventually, I'm going to reach 22%, 24%, or maybe even 32% in the income tax bracket, because ideally my income is supposed to go up, right? And I strongly encourage you to reach out to your local CPA to find out if you're doing the right thing. Or you can have a chat with me by going to firesection.com/coaching. Another option you have is to contribute to both Roth and traditional 401k at the same time. The 401k contribution limit, again, for 2023 is $22,500 or $30,000 if you're over the age of 50. You can contribute to both Roth and traditional as long as you don't exceed the personal contribution limit. And I know people who elect to do 50% Roth and 50% traditional to lower their taxable income. And personally, my tax threshold for Roth is the 32% marginal tax rate. And a lot of people would probably agree with me on this. And let me know in the comment section down below, what is your maximum, like at what point would you contribute into the traditional 401k or something else? My income is not quite there yet, though. I'm not at 32%. But when I reach 32%, I'm going to want to reduce my taxable income by putting some money towards the traditional portion of my 401k. If I'm barely on the edge of the 32%, I'm just going to put some of my gross income in the traditional 401k now. So when I retire later, I can convert it to Roth when my tax rates are a lot lower. So the bottom line is that I would rather pay 22% or 24% in marginal tax rate when I retire than pay 32% in marginal tax rate now, right? And it's really up to you. As long as you have the taxes figured out for your benefit, what really comes down to between Roth and traditional is, do you want to pay taxes now or later? And I want you to download my absolutely free 401k calculator by visiting firesightchat.com/resources. And I'm also going to show you how to calculate your 401k based on your age later on in this live stream. And if you're watching this on replay, you can just go to my 401k YouTube playlist and find the 401k calculator tutorial video. And I'm sure you want to know how much your 401k will grow in the next 10, 20, or 30 years, right?